Welcome to Tech Money Madness, your daily U.S. stock market deep dive. It is July 22, 2026.
Glad to be here for this one.
Yeah, and today we're unpacking a really comprehensive daily market briefing. Our mission is to basically cut through the red ink of today's market close.
Right, because there's a lot of red.
Exactly. I mean, we've got mixed signals across tech earnings, a hidden global infrastructure boom, and just this unprecedented wave of regulatory moves out of Washington.
It's a heavy news day for sure.
It really is. And the goal today is to figure out what these cross currents actually mean for the broader economic picture, and how you should be looking at all this market volatility.
Because the headline numbers are definitely screaming one thing, while the underlying shifts are, well, they're telling a totally different story.
Right. I like to frame today's market landscape like report card day at a really competitive school.
Oh, I like that analogy.
Yeah. So some of the star students are suddenly showing these weird cracks in their grades, while others are just quietly building the school's new computer lab in the background.
And the disconnect between the raw data and the market's reaction today it's unusually wide.
It really is. I mean, we're seeing major indices like the S&P 500 and the Nasdaq close lower, obviously driven by those tech misses.
Right. But if you look closer, the internal sector rotations reveal a lot of hidden resilience.
So let's start right there with that resilience, because the first big headline today is Tesla. And the report card is, frankly, it's messy.
Very messy.
They missed earnings expectations, their free cash flow turned negative, which is huge, and their profit margins are sliding.
Yeah, the math is brutal right now.
It is. You have more cash going out the door to fund operations than coming in, and the profit on every single vehicle is shrinking.
Exactly.
Yet the stock showed this bizarre resilience today. So I have to ask, is this just an EV halo effect? Like, are investors completely blind to the math, or is there an actual, mechanical reason the market isn't punishing them for negative cash flow?
Well, it is definitely mechanical. What we are seeing is this phenomenon where institutional investors apply a heavy discount rate to current missteps, assuming a company is undergoing a highly credible structural pivot.
Okay, so they're giving them a pass.
Right. Think of it as the forgiveness of the future. The algorithms and the institutional models, they aren't just looking at the negative cash flow in a vacuum.
They're looking at what the cash is buying.
Precisely. They're weighing it against the specific capital expenditures that are driving it. So for Tesla, the core auto business is actually showing these early data points of a rebound in demand.
Oh, wow. Okay.
Yeah, so the market looks at the sliding margins and basically says, okay, the current ledger is bleeding, but the fundamental appetite for their underlying product is stabilizing.
So they're treating the cash burn as like a temporary toll required to bridge the gap to the next growth cycle.
Exactly. But it's a tightrope.
Right, because at what point does that forgiveness run out? I mean, the market can't ignore a bleeding ledger forever just because the future looks bright,
It runs out the exact moment the forward-looking metrics miss their targets.
Like delivery growth.
Right. New vehicle deliveries, energy storage deployment. If those leading indicators hold up, Wall Street will absolutely finance the transition.
What if they stall?
If they stall, the forgiveness evaporates instantly, and the stock will just violently reprice to match the current negative cash flow reality.
Wow. Okay, so that dynamic is actually playing out in an even stranger way with IBM today.
Oh, the IBM situation is fascinating.
It is. So they issued a formal earnings warning and lowered their full-year forecast. And usually, a lowered forecast triggers a massive sell-off.
Oh, a total cratering, usually.
Right. But to counter this, IBM is loudly pointing to artificial intelligence. Specifically, this new internal AI coding tool they built named Bob.
Good old Bob.
Good old Bob. They're claiming this tool will drastically boost their own productivity. So are investors actually buying the idea that an internal software tool can offset a massive macroeconomic revenue slump?
Surprisingly, they are. Because IBM is shifting the narrative. They're moving the focus from top-line revenue growth to bottom-line margin expansion.
Okay, break that down for me.
Well, if your traditional revenue streams are softening, which IBM is openly admitting they are, you basically have two choices. You either shrink the company or you drastically lower the cost of producing your goods and services.
And Bob is the cost cutter.
Exactly. By rolling out an AI coder like Bob, IBM is signaling a massive reduction in future human capital costs.
So they're telling the market, hey, even if we make less money overall next year, we're going to keep a higher percentage of every dollar that comes in.
Right, because the AI is doing the heavy lifting of software development instead of, expensive human engineers.
So they are basically masking a sales problem with an efficiency narrative.
That's one way to look at it, yeah.
But here's the catch. IBM relying on an AI tool like Bob to save their margins requires an astronomical amount of computing power.
It takes a lot of juice.
Exactly. You don't just conjure Bob out of thin air. You have to train it, run it, maintain it, and that requires physical hardware.
Massive data centers.
Right. Which brings us to the second big theme today. The narrative is shifting from the companies promising an AI future, like IBM, to the companies physically building it today.
Yeah, the infrastructure layer is where the undeniable capital is flowing right now.
So let's talk about AMD. The briefing notes, they are making an investment of up to $5 billion in Anthropic.
Which is huge. Anthropic is one of the premier AI research labs out there.
Yeah, but why does AMD need to spend $5 billion on an AI lab? I mean, why not just spend that money designing faster chips?
Because in the AI space, the hardware is functionally useless without the software optimization to run the models.
Oh, I see.
Look at NVDA. They've dominated the market for years, not just because of their chips, but because their software platform, CDA, became the absolute industry standard for AI developers.
Right. Everyone builds on CEA.
Exactly. So AMD is investing heavily in Anthropic to ensure that Anthropic's massive, cutting-edge AI models are natively optimized to run on AMD's architecture.
Oh, so it's an ecosystem play.
It's a computing power deal designed to prove to the rest of the enterprise market that AMD chips can handle the absolute heaviest AI workloads just as well as NVIDIA.
They are basically buying structural relevance.
Exactly.
Which naturally brings us to NVIDIA. The briefing notes, they are continuing their dominance, but it highlights something very specific. It says they have a stranglehold on the inference market.
Yes, the inference market.
Now, when most people hear about AI chips, they think about training the models, right? Like feeding billions of data points into a supercomputer for months. But inference is different.
Very different. Inference is the application phase.
Okay.
Think of training an AI model like sending someone to medical school. It takes years, it is incredibly expensive, and it requires a massive concentration of resources.
Right, lots of money up front.
But inference is what happens when that doctor actually sees a patient and diagnoses a symptom.
Oh, that's a great way to put it.
Right, so every time you type a prompt into an AI chatbot, or every time IBM's Bob writes a single line of code, that is inference.
So while training is a one-time capital expenditure, inference is perpetual.
Precisely. As AI moves from the research phase into daily global utility, the volume of inference requests is going to completely dwarf the training workloads.
Because everyone is using it all the time.
Exactly. NVIDIA dominating the inference market means they are securing a permanent, recurring revenue stream built into the very fabric of the Internet's next iteration.
Every query, every automated task, it all runs through their silicon.
It really does.
But there's a massive bottleneck in that silicon that no one really talked about, which the briefing calls the MEMI boom.
Ah, memory semiconductors.
Right. It notes this sector is exploding due to AI and smartphone demand, and it's uniquely benefiting small-cap manufacturers, emerging markets, and especially Japan. So how does memory dictate the pace of AI?
Well, you can design the fastest processing chip on the planet, but if it cannot pull data from memory fast enough, the processor basically just sits idle, waiting.
Like a sports car stuck in traffic.
Exactly. AI models require high bandwidth memory, or HBM, and these are incredibly complex stacks of memory chips literally layered on top of each other.
Oh, wow.
Yeah, and the manufacturing process for HBM requires profound precision in material science, specifically the chemicals, the photoresists, and the silicon wafers used to etch these chips.
And that is where Japan comes in.
Yes. Japan holds near monopolies on several of these highly specialized precursor chemicals and the precision tools required to fabricate advanced memory chips.
So the capital flowing into AI isn't just stopping in Silicon Valley.
Not at all. It is cascading down the global supply chain, and it's revitalizing Japanese industrial sectors and these specialized manufacturers who provide the literal plumbing for this infrastructure.
Which creates a fascinating contrast. You have billions flowing into the foundational plumbing of AI, but consumer-facing tech is hitting this brutal ceiling.
It really is. Look at the smartphone market today.
Right, Samsung just announced their new foldable lineup. The Galaxy Z Fold 8 Ultra, the Z Fold 8, and the Z Flip 8. They are packing these devices with tech to try and force consumers to upgrade.
And meanwhile, the briefing highlights serious valuation concerns for Apple.
Yeah, they are sitting at a forward price-to-earnings ratio of 34x, with real fears that their high device prices are stalling customer upgrade cycles.
And a forward PE of 34x implies that investors are willing to pay $34 today for every single dollar of earnings Apple is projected to make next year.
That's wild.
It is. That valuation demands absolute perfection. It assumes unrelenting growth. But consumer hardware has an elasticity limit.
A consumer will eventually look at a new $1,200 phone and just decide, their current phone works fine for another 2 years.
Exactly.
I look at Apple right now like this stunning high-end luxury car dealership. The cars are gorgeous, the branding is pristine, but foot traffic is slowing down because the sticker shock is finally outpacing wage growth.
People just aren't trading in their cars every year anymore.
Right, and meanwhile, outside that dealership, AMD, NVDA, and those Japanese memory manufacturers are paving the literal asphalt highways that every car has to drive on regardless of the brand.
That's a great way to look at it. It feels like a fundamental transfer of market leverage from the consumer layer to the infrastructure layer.
Definitely.
A consumer can delay an iPhone upgrade. An enterprise tech giant cannot delay a server upgrade, because if they fall behind in AI compute, their entire business model faces obsolescence.
The demand at the infrastructure level is highly inelastic.
Unbelievably inelastic.
Okay, let's pivot away from tech for a second, because there is an entirely different strategy working in the broader economy that requires absolutely zero AI infrastructure.
Oh, Southwest Airlines.
Yes, Southwest just reported a massive 9% increase in second quarter profit, and their strategy, they literally just raised ticket prices to cover their rising fuel costs.
That's so simple.
They passed the inflation directly to the passenger, and it worked beautifully.
But wait, isn't there a ceiling to that? At what point does an $800 domestic flight just destroy their demand entirely?
Oh, there is absolutely a ceiling, and airlines walk a very tightrope trying to find it.
So how did they pull it off?
The economic concept here is price elasticity of demand. Southwest recognized that for a specific segment of travelers, whether that's corporate or, essential personal travel demand, was inelastic enough to absorb the fuel surcharge.
Because if you have to be at a wedding or a board meeting in Chicago, you pay the fare, you complain about it, and you get on the plane.
Exactly. But the broader market takeaway here is really about defensive posturing.
Oh.
In a market where tech valuations require perfection, companies with raw pricing power, the ability to pass inflationary costs to the consumer without sacrificing volume, they become highly attractive safe havens for investors.
It is a brutal, simple efficiency.
It is. And we are seeing the definition of what constitutes a foundational company really blur right now. The briefing mentions Amazon was just included in StarTrader's new 247 CFD offering.
Right, contracts for a difference.
Yeah, for those listening, a CFD allows traders to speculate on the price movement of an asset without actually owning the underlying stock. But the key here is the 247ing aspect. Amazon is now being traded around the clock, like a currency or a commodity.
Including Amazon in a 247 liquidity pool really reflects how institutional capital views its systemic importance.
It's more than a store now.
Way more. Amazon is no longer just a retailer. Through AWS, it operates a significant portion of the internet's infrastructure. And through its logistics network, it dictates physical supply chains. Wow. The global financial system now demands the ability to price Amazon's risk and value at all hours, responding to global events in real time. It basically trades like a utility because, functionally, it has become one.
That real-time global risk brings us perfectly to the final and maybe the most complex piece of today's deep dive.
The geopolitics.
Yeah. Southwest's fuel costs don't happen in a vacuum. They are dictated by global energy markets. And those markets are currently being upended by this massive wave of geopolitical and regulatory friction.
The volume of Washington oversight in today's briefing is just staggering.
Let's start with energy. The U.S. and Saudi Arabia signed a new nuclear power agreement, but it requires congressional review under the Atomic Energy Act. How does that specific legislative mechanism impact the market?
So the Atomic Energy Act requires what's called a 123 agreement for the U.S. to share significant nuclear technology with another country.
Okay.
And Congress legally has a continuous 90-day session window to review and potentially block that agreement.
So it puts a massive global energy shift into a 90-day political limbo.
Yes, and markets despise limbo.
Of course they do.
When you have Saudi Arabia, one of the primary governors of global oil prices, shifting its domestic grid toward nuclear power via U.S. technology, it changes long-term fossil fuel demand models. But because Congress can intervene, energy traders cannot cleanly price in the deal. They have to price in the probability of the deal surviving congressional friction.
And energy isn't the only sector facing new guardrails today. There is a new Senate crypto bill introduced.
This one is interesting.
It is, because it's aimed inward at the government itself. It seeks to impose the first-ever limits on federal officials, including presidents, banning them from issuing or sponsoring digital assets.
Right.
Why is it legally necessary to ban a federal official from launching a crypto token?
It really comes down to the mechanics of systemic market distortion. Right. If a sitting president or a high-ranking federal official issues a digital asset, their regulatory authority inherently conflicts with their financial product.
Because they possess the power to draft the very laws that govern their own coin's competitors.
Exactly. And more deeply, a government-sponsored asset carries this implicit state backing in the eyes of retail investors, even if none exists legally.
Yeah. People will assume it's guaranteed by the government.
Right. This bill is a preemptive firewall. Lawmakers recognize that digital assets have grown so integrated into the financial plumbing that allowing executive sponsorship could wildly distort capital flows.
It's an unprecedented conflict of interest.
Completely.
The push to check executive power continues with another bill, this one from Senator Ron Wyden. He introduced legislation seeking to curb Trump's tariff powers, citing past abuses. We are looking at Congress actively trying to pull back the president's ability to unilaterally dictate international trade penalties.
The mechanism of tariff authority is really critical here.
How so?
Historically, Congress holds the constitutional power over trade and tariffs. But over the decades, they delegated a lot of that authority to the executive branch for the sake of speed and national security.
So Wyden's bill is trying to reverse that?
Yes, it represents a legislative attempt to claw that power back. For the market, tariffs act as an immediate, unpredictable tax on global supply chains.
So if a president can just wake up and enact a tariff, supply chains panic.
Exactly. If tariff authority is pulled back into the slow, deliberative process of Congress, multinational corporations can model their supply chain costs with much more stability.
Because they see it coming.
Right. But as long as it remains a unilateral executive lever, the risk of sudden cost spikes remains really high.
And layered on top of all this legislative tension is a stark physical reality. A U.S. Secret Service official reported today that the threat environment is at an all-time high, noting a 40% increase in cases involving threats to protectees.
Which is deeply unsettling for the markets.
It is. If I am a retail investor looking at my portfolio today, how on earth do I build a mental model for this? I mean, I can model out Tesla's margins and I can understand Southwest ticket prices, but how do you price in a 40% spike in security threats, a congressional battle over nuclear energy, and a tug of war over presidential tariffs?
You price it in through the risk premium.
The risk premium?
Yeah, the risk premium is the extra return investors demand for taking on uncertainty. When geopolitical and domestic volatility spikes, when you have threat levels rising and massive legislative uncertainty, the risk premium expands.
Meaning investors refuse to pay a premium for speculative, unproven companies.
Precisely. They rotate their capital into defensive postures. They look for companies with inelastic demand.
Like we talked about.
Right. They look for the NVDA inference chips that the internet literally cannot function without, or the Southwest Airlines that can force consumers to absorb inflation.
So macro chaos basically accelerates the flight to fundamentals.
Exactly, because when the legislative and geopolitical environment is this noisy, you only want to own assets where the underlying math is undeniable.
That makes total sense. Let's pull all of these threads together and synthesize what we've unpacked today. We are clearly looking at a market in a profound state of transition. At the consumer level, the limits of pricing power are showing. Tech giants relying on constant hardware upgrades are facing real valuation skepticism. But beneath the surface, the infrastructure layer is executing this massive capital capture.
Yeah, the companies building the high bandwidth memory and the AI computing networks, They are securing permanent dominance.
At the same time, traditional economy companies are proving that brutal, simple pricing power remains a premier defense against inflation.
And all of this corporate maneuvering is happening beneath a canopy of intense geopolitical strain.
Right, where Washington is actively trying to rewrite the rules on energy, digital assets, and global trade, it is a landscape that really demands you look past the immediate headline.
You really have to dig into the mechanics right now.
You do. But before we sign off, I want to leave you, the listener, with a final thought to mull over, and it brings us all the way back to IBM and their internal AI coder, Bob.
Go, Bob.
Yeah. IBM is banking on this AI to make their workforce incredibly efficient, cut their costs, and save their margins. And it is a brilliant strategy for today.
For today, yes.
Right, but think about the mechanics of this a few years down the road. If every single company across every single sector adopts the exact same AI productivity tools to streamline their workforce, doesn't that competitive advantage mathematically vanish?
It has to, right?
Yeah. If a tool is available to everyone, it ceases to be an advantage and simply becomes the new baseline. So when every company is suddenly super productive, does the cost of doing business just shift, leaving these corporations right back at square one, fighting for margins against competitors who are operating at the exact same hyper-efficient speed?
That is the ultimate paradox of technological commoditization. You implement the technology to pull ahead, but once the technology becomes standard, you're just running faster to stay in the exact same place.
Keep questioning the baseline. When the headlines tell you a stock is falling, look at the capital expenditures behind it. When a company promises an AI revolution, ask who is actually manufacturing the memory to run it. Thanks for joining us on this deep dive. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.